As long as the arbitrage bots are built correctly, essentially arbitrage bots don't lose money. It's more just how much do you make is really the question. Assuming that some material percentage is getting arbitraged by LeoStrategy, that is pure revenue for LeoStrategy. And that revenue gets used to buy more Leo and add it to their balance sheet. What gets really fascinating there is any revenue generated by LeoStrategy, whether it's market making revenue or revenue from Leo collateralized loans or whatever they end up building in the future, Leo is adding Leo per share to LeoStrategy at a $0 cost of acquisition. Essentially, it's some sort of automated service that is providing value and earning revenue and using that revenue to buy Leo, which means that LeoStrategy is adding Leo per share without any dilution to LSTR holders and without any cost of acquisition on that Leo. Technically, infinitely accretive is what they call it. When you buy something with a $0 cost of acquisition, any future upside is infinite because you had no cost. I think that's where things get really interesting for LeoStrategy in its makeup in the strategy company ecosystem. It's a lot different than things like Microstrategy. They've got employees, all sorts of costs of being a public company. So there's a lot of overhead. So the ability to generate a profit and then use that profit to buy more Bitcoin, or Leo in LeoStrategy's case, is a very unique competitive advantage versus other companies, which is pretty much zero overhead. The overhead is whatever it costs to build and maintain these apps. If you've been paying attention, things like LSTR.voter, things like the market maker, things like surge.yield, things like this website, they're very simple, they're very low maintenance, and that is clearly being considered in the build process. Is like, how do you build very low maintenance AI driven applications that generate revenue? Whether it generates $100 or $1 million a month, any dollar generated is infinitely accretive to LSTR holders because they use whatever dollars are generated, they use to buy more Leo and add it to the balance sheet permanently. So things get really interesting as LeoStrategy continues to build out applications and revenue generating products. I think the market maker is going to be the biggest one. I think it's pretty obvious. You see 775,000 in monthly Leo trading volume. Now you add in LSTR, which I think is already doing about 150K. And then you add in Surge once the pre-sale is over. And now you've got these three tokens with cross-chain pairs and Hive Engine pairs that are all generating monthly trading volume. LeoStrategy can have a moat for arbitraging these. That is another competitive advantage. And I mentioned that I would get into it for LeoStrategy, which is LeoStrategy has a moat for any of the cross-chain pairs. So for the Hive Engine pairs, they don't have a moat, because technically anybody can compete, right? There's no fees or anything like that on Hive Engine. So that makes it a lot more competitive. Basically, LeoStrategy needs to be the fastest and best market maker on Hive Engine if it wants to make a profit there. That is essentially what they're building right now. It's already live. I've been tracking it in terms of on-chain. But when it comes to cross-chain pairs, this is where things get really fascinating, because with BLeo, PLeo, HELeo, Leo on Arbitrum, and then LSTR on base, Surge on base, and then obviously all the Hive Engine crossover pairs, LeoStrategy has a moat on that because it's going to have a whitelisted fee that is lower than the market fee. Imagine that the fee to bridge is 1.5% on all the Leo pairs, on all the Surge pairs, on all the LSTR pairs. So the fee is 1.5% for everybody, but LeoStrategy's market maker has a whitelisted fee of 1%. That means that LeoStrategy can market make anything between 1 and 1.5% profit, and it can do it with no competition, because any other arbitrage bots can't do so profitably until it surpasses 1.5%. That essentially gives LeoStrategy this window of 1% to 1.5% to play with. So for example, let's say the BLeo pair is trading at a 1.4% discount to the HELeo pair. LeoStrategy's arbitrage bot can buy Leo, BLeo on BSC, and then it can unwrap, or rewrap it back to Hive Engine Leo, and then sell that Hive Engine Leo on Hive Engine at a 1.4% premium to what it bought it for. The bridge charged LeoStrategy 1%, so LeoStrategy keeps the 0.4% profit. No other bot could have competed because the bridge fee for anybody other than the LeoStrategy market maker is 1.5%. If that is the case, then essentially LeoStrategy just did this arbitrage with no competition. 0.4% was profit for LeoStrategy and 1% was burned, because that's how the Leo bridges work. The 1% from the bridge fee is burned. The Leo economy profited in terms of burning Leo, and LeoStrategy's fund profited in terms of the 0.4%. This is just an example, hypothetically. If you imagine this in production and this total volume number grows over time, that is pure arbitrage volume and potentially pure profit for LeoStrategy to add more Leo to its balance sheet, which then allows it to expand the offerings of LeoStrategy's fund, which then leads to more volume because, LSTR grows, Surge grows, potentially other products in the future emerge and grow. So as the balance sheet expands through profits, it then leads to more volume, which then leads to more profits, which then leads to more balance sheet expansion, which then leads to more volume. You can see how the flywheel turns on that. So Michael Saylor has famously said that volatility is vitality. He's essentially talking about very much what I just described here, which is if the Leo volume is $0 a month, if the Surge volume is $0 a month, if the LSTR volume is $0, there's no potential profit there for LeoStrategy. However, if the volume is 775,000 like it was last month, if that continues to grow, that increases the vitality of the market making profits for LeoStrategy, which then leads to profits getting reinvested in more Leo, which expands the balance sheet, which then leads to more volume because the whole economy is scaling upwards over time. LeoStrategy's stated mission is to get the total trading volume of Leo and all Leo-based derivatives, which are essentially anything created by LeoStrategy. So Leo, LSTR, Surge, and all the pairs that come with that. I think once LSTR and Surge are launched as cross-chain pairs on Base, we'll have around 25 pairs in terms of Leo and any Leo derivative pairs that LeoStrategy can market make. So it's 25 different pairs. They're all moving, at different prices at different times. When someone trades into one of the pairs, it offsets all the other pairs and creates arbitrage loops. Essentially, if you can imagine, their stated goal is that all 25 pairs have $1 million a day in trading volume. Well, that's $1 million a day in trading volume that can potentially have some material percentage harvested for arbitrage profits by LeoStrategy. Use those arbitrage profits to buy more Leo, which increases the balance sheet in terms of USD value, which then can lead to more potential volume in the future. So, if they're successful with this flywheel and getting to $1 million a day in trading volume, not just on the Leo pairs, but on LSTR and Surge pairs, things get really interesting. The thing to watch will be the total trading volume and how much LeoStrategy is able to arbitrage that total trading volume. So that's kind of what I'm going to focus on when it comes to evaluating LeoStrategy's success in terms of the market maker.